There is a lot of planning you can do as you approach the end of the tax year, which is the 5th of April. And planning to maximise the use of income tax allowance and exemptions is probably relevant to most people. But it does bring its own challenges because unless you have complete control over your income sources, making sure you've used those allowances and exemptions at the very last minute can be quite tough. That's why income tax planning is far better done at the beginning of the tax year than at the end, if you can. But that doesn't mean there's nothing that you can do. One factor that helps us with income tax planning is the period of relative stability we're in right now in relation to the allowances, exemptions and thresholds. It's probably the kind of stability that we don't really want and could do without, because that stability is being caused by the freezing of the allowances and thresholds until April 2026, i.e. they're not going up. The first area of income tax planning I'm going to talk about is income from investments. And the first thing to consider if you're a married couple or in a civil partnership is whether your income is set to flow in the right way, so that one of you isn't overtaxed and the other one undertaxed in essence, but you want to try and somehow equalize the amount of income that you're getting. If you have the option to transfer the source of income from the higher tax-paying spouse or civil partner to the lower tax-paying or non-tax-paying partner, it can be hugely beneficial. With investments that are using to generate income, that would mean transferring the investments or the capital from one spouse or partner to the other. Now, normally a transfer of capital to someone else would trigger a capital gains tax liability if there was a gain, but that's not the case with most asset transfers between spouses or civil partners. You can transfer your investments from your name into your spouse's name without giving rise to any capital gains tax or inheritance tax complications, but it must be outright and it must be unconditional. Now, there are two things to note here. You cannot take advantage of this rule if you're separated, even if you haven't divorced yet and have not lived together in the current tax year. And the new owner of the investments may still be liable to capital gains tax as and when they come to sell them. So making sure the capital or investment that generates the income are actually owned by the right person is a great piece of tax planning. The other allowance to consider when it comes to investments is the dividend allowance of £2,000, which can only be used if you're actually receiving dividends, of course. Again, consider who is the owner of the dividend producing investments. Finally, there's also the personal savings allowance of £1,000 for basic rate taxpayers and £500 for higher rate taxpayers. Similarly to investments, if you're generating income from your savings above the personal savings allowance level, you should think about how you and your spouse or civil partner can receive that income tax efficiently. Now, one way to do that is to transfer the ownership of the savings to the person who pays the less tax to take advantage of the higher allowance. Be aware that when working out which income tax band you fall into for the personal savings allowance, you have to add all the interest you've received in the year to all of your other income. Hope that's helpful. Thanks for checking out my YouTube channel. I'm Justin King. I'm a chartered and certified financial planner, and my aim is to help people live successful lives, and that often involves understanding your money. I really hope you've enjoyed this video. If it's been useful for you, if it has, please press the like button to help more people like you find my channel. And of course, subscribe so that you get notified of new content that I put out. For now, I'm Justin King, helping you live your best life.